Well, it looks like the silver squeeze is still happening, and I'll explain why. Jeff Christian, managing partner of the CPM Group, is here to discuss silver and what happened last month and how the markets are still reacting to what happened last month. Jeff, it's a very interesting discussion we'll have today. I'm looking forward to it. The CPM Group is launching a report this Thursday talking about the silver squeeze and some of the things they got wrong. You were telling me offline. Why don't you start by introducing us the synopsis of this report?
Okay. Well, yeah, the silver report that we're releasing on Thursday isn't actually about the silver squeeze. It's about the silver. CPM Group for the last 16 years has had a silver reception on opening night at the PDAC. PDAC is virtual this year. So rather than do that, we will have a webinar at 11 o'clock Eastern time on March 4th. It's open to the public, and I think Kitco is one of the distributors and media partners in that project. But it's going to be a global webinar covering silver. And simultaneous to that webinar, we'll produce a report, a small report, as we have for the last 16 years with the silver receptions at the PDAC. Now, obviously, one of the topics that we'll cover is the short squeeze and what they got it wrong. We'll show some data about what happened with the SLV in the first week of February.
Yes.
And we'll show some data about the enormous amounts, record amounts of silver that's held in bullion form, good delivery bullion form in London, New York, Zurich, China, and why it is that there's no real shortage of silver. There's a shortage of like coins and small bars, but there's no shortage of silver.
Okay. A friend of mine actually texted me last night. He said, check out this GoFundMe. And what they're doing is they're raising money to short silver again. So they've raised about $77,000 so far. I think their goal is $100,000. And I'm not entirely sure what they're going to do with this money and how they're going to utilize it to short silver. But anyway, I think there's still interest from at least the millennial crowd to continue the short squeeze trade. What do you make of this?
The problem with these guys is they don't know what they're doing. They don't understand commodities markets. They have been playing with freely margined equity trades on the equity market, where you actually have investors who will borrow silver shares of a stock of a company and then sell those shares in the expectation that they can buy them back if the price falls more cheaply to pay back their loan. So you do have naked shorts in the silver market as shorts. In the commodities market, you have some investors who do that, but the vast majority of the positions that you see as short positions on the commodities exchange across commodities actually are hedges of physical positions by commercial trade entities. Now, one of the mistakes that people who don't understand commodities markets make is they think that when it says commercial short position, they think that those are producers and refiners and fabricators, commercial industrial companies. But in reality, most industrial companies do not trade directly on the futures market. They trade with banks or dealers because it's more convenient for them, they think. And then those banks and dealers will hedge their physical or OTC transactions with futures and options. So the commercials that get reported through the commitment of traders are actually primarily financial intermediaries, banks and dealing companies. And that's one of many mistakes that these guys don't understand. In addition to that, you had some problems because they were trying to squeeze the SLV ETF on the first week of February. And they didn't understand that the problems that arose, they misdiagnosed them, and I can explain that if you really care, what actually was happening there with the SLV. Yeah. But it wasn't that the metal didn't exist in London the way they thought. It was really much of a more mechanical issue with just clearing the volume of trades that they had.
Yeah, for sure. We really care. We're really interested to know why the short squeeze didn't push up silver above $30 an ounce. People were expecting it to happen, but it kind of just fizzled out. We didn't see the same effect as GME, AMC, all these other stocks. What happened there? I mean, there's a lot of theories as to why it didn't work out. Some people speculated that it actually did work because what we saw was a run-of-the-mill on the physical front. The bars and coins, the dealers were out of inventory, so the premiums in the physical side. So the paper market didn't move up, but the physical side moved up. You saw premiums rise, right? So how do you digest this?
When you say the physical market, you're talking about small products, coins,
Sure.
medallions, and small bars.
Sure.
And those premiums skyrocketed because small investors who didn't know what was going on in the futures market and with SLV got all excited that the price of silver was going to rise, and they bid those things up. There's also shortages of those small products because of the way mints and refineries have managed their production facilities to avoid the pandemic spreading across their people. And we can talk more about that. So that's one of the things. The other thing is, I would argue that, and in fact, in our report, we'll have a chart that shows you, and we'll show it on the webinar. The price of silver rose in late January into early February because of the role of futures out of the February contract, or out of the March contract into the May contract. And that was one of the factors that was supporting the price at that time. Whether or not the SLV squeeze attempt actually had a lot to do with the price strength at that time is questionable. And it's questionable for a variety of reasons. One about, if you look at other markets, there were other commodities, including gold and platinum and palladium, that were rising at the same time. So you don't know why they would be rising if people are focusing on squeezing the silver market. So it looked like it was a broader set of factors that were pushing silver prices up at that time, as opposed to the squeeze.
So if a bunch of investors or a large community of investors buy the SLV ETF, does that have any effect at all on the underlying price of the commodity itself, silver?
It can have an effect on a short-term basis. The reality is, as I said, you have record amounts of silver in London and New York inventories. The SLV is very funny because some of these guys were talking about COMEX silver and not having enough silver in New York to meet the SLV demand, which is not true. You had enough. But it's doubly not true because the SLV actually takes metal in London, not in New York. If you look at the London inventories, you're at record levels. You've got about 1.1 billion ounces of silver in London inventories. About 450 million ounces of that is unallocated. So ostensibly it's more readily saleable. Although to tell you the truth, a big part of the allocated metal can also be sold too, because it's not that difficult. If you own allocated metal, it's not that difficult for you to say, gee, the price is 20%, 30% higher than when I bought it. I think I'll take my profits. So there's plenty of silver around. The issue that happened with the SLV is that if you look at the SLV trading volumes, not the trading volumes, but rather the volumes of redemptions and additions to inventories on a daily basis, the average day trades somewhere between zero. There are a lot of days where there's no redemptions or additions to the SLV inventories, but typically it trades between 0 and maybe 1 or 2 million ounces of shares being added to or taken out, and it goes both ways. When these guys tried to squeeze this thing, all of a sudden you shot up to like 95 million ounces of new additions to the SLV. And then they realized that there was a mistake and they liquidated about half of that, about 45 or 50 million ounces over 2 days. Yeah. And you've got a system that clears on average a couple 100,000 ounces worth of silver SLV shares a day, sometimes 1 million or 2 million ounces worth of shares. All of a sudden that system is needing to clear 95 million ounces. And it's just not there. So it wasn't that the metal wasn't there. It was that the capacity to clear 95 million ounces worth of SLV shares in a given day wasn't there.
Can you tie all this back into a recent YouTube video that you've done entitled "Silver Futures Contract Default Not Likely"? And what do you mean by that?
Well, there are a lot of people, again, who consistently misunderstand, purposefully or by accident, how the market works. So you've had people since the mid-1980s say that, oh, there's not enough silver to meet all the demand, and you're going to see a default in the silver market. And you've had promoters, primarily people who sell precious metals products, touting to investors, oh, the silver market's going to explode because there's not enough silver to meet all this demand, and there's these massive naked shorts that don't actually exist on the COMEX, and the silver market's going to explode. And, Kitco has interviewed me for 30 years about this. JP Morgan's going to go bust. Goldman Sachs going to go bust. Merrill Lynch before them. Drexel Burnham in the 1980s, had these massive naked shorts, which they didn't. But they're going to blow up in their face. And you'll see these guys come on Kitco. You guys like to promote them. And they'll say, oh, by October, the price of silver is going to be $100 because it's going to blow up. And it doesn't blow up, right? If you look at the ratio of, say, what they tend to do is they'll look at the ratio of open interest to metals. And they say, okay, there's big open interest, 700 million ounces or whatever. And there's only 400 million ounces now of silver registered or eligible in the New York market to meet that COMEX demand. So if everybody who has open interest takes delivery, the market blows up and defaults. First off, it doesn't default. It just changes to a cash-only settlement, or it resolves it in a different way, which the bylaws of the COMEX have always had in the capacity to do. Yeah. And they did a liquidation only order in the late 1970s when there was congestion in the silver market related to but not caused by the hunts. But what you need to do is you need to realize that 99.x% of those open interest, those trade contracts never get delivered upon. That's one thing that they don't get. You have to look at deliveries versus shares, and the ratio of deliveries relative to the amount of metal that's in COMEX is at record low levels. There's never been more metal covering the deliveries, at least since the 1980s. So that's the other thing. And the other thing is you have to understand the deliveries are of warehouse receipts, not of silver. So obviously you have to have silver there if you have a warehouse receipt, and you need the warehouse receipt, but it's not like there's this scrounging for physical metal when somebody takes delivery on the COMEX. When somebody takes delivery on the COMEX, they get a warehouse receipt. It says, this silver already exists in a COMEX registered recognized depository, and here's the warehouse receipt. And you maybe put up 10 or 15% of the value on margin to buy that contract, and now it's being delivered to you so that you have to put up 100%, which is why the COMEX has a mechanism, as do other futures exchanges. If you take delivery, you can redeliver it the next day and not have to put up 100%. So there are mechanisms there that are very common. You can buy a book on Commodities Trading 101 and understand this stuff. But there are a lot of people in the silver market who've never read those books and who don't understand what the delivery process is. They don't understand the nature. They don't understand the purpose for which commodities markets exist.
So let's just sum up here. When we're putting a bunch of money in to quote unquote short squeeze silver, what really is the net effect? Is there any substantial net effect on the silver market?
You can have a short-term effect pushing the price up, but probably the overall effect is that you'll lose your money.
Yeah. Okay. Well, we all right. Well, I mean, we did see a lot of people put in a lot of.
It's the silver equivalent of thinking that you and a bunch of other poorly armed people can storm the Capitol and overthrow the government. You're probably going to get hurt.
Well, yeah. Well, okay. So. There are a couple of theories out there. The financial institutions who are, I guess, on the long side, they're the ones that are going to get hurt from the short squeeze. But you're saying, based on what you said, it sounds like you're saying that no, the deliveries are not going to hurt them in any way.
It's not. They are not going to get hurt by the short squeeze. They're actually getting help by the short squeeze.
Okay.
Because the financial intermediaries actually are short the futures, but they're long physical. The short positions that they have on the futures contract primarily are hedges of physical metal. And that's physical metal that they've lent out to producers, smelters, refiners, fabricators, and others. They get, Banking 101 is, I'm not trying to make money based on the capital appreciation of my deposits. I'm trying to make money by charging little fees for things.
Okay.
Right? And banks make most of their money in precious metals by lending that metal out to people who need to use it, who don't want to put up 100% to finance their working inventories. Mm-hmm. So if the price is $25 in mid-January and a bank is charging 3% interest, he's earning 3% of $25. If some people come in and drive the price to $30 and happen to do it at the end of the month when a lot of these rates are locked in, the bank is getting 3% of $30 instead of $25. You have just given that bank a 20% boost in its revenue. So the short squeeze doesn't hurt the banks that are short the futures market. The short squeeze actually helps.
What about the another theory I've heard is that the industry itself is trying to suppress the metals. If you look at the industries that use silver a lot, battery technology, Tesla. These are some of the companies that have an incentive for the silver price to be low, and they would benefit from the production side. First of all, is there any validity to this theory? And I guess what the silver squeezers are trying to do is also to show them that what they're doing is wrong.
There's no validity to that. That's just silly. That's just plain silly. No, the industries that use silver don't like the fact that the price of silver is much higher than it used to be, but they're not trying to diddle with the price in the futures market or any place else, and they're not trying to suppress the price. They're trying to find ways to use less silver per unit of output.
Yeah. Okay. All right. Well, I mean, these notions, these theories must come from somewhere, right? Is there any research that you've done that would point to suppression of the silver markets by industry? Not at all?
There's been a massive amount of research that we've done and that others have done. And what you find is that there's no evidence supporting any of these conspiracy theories. There's an enormous body of evidence disproving these conspiracy theories. And there's a lot of evidence that says there's no such conspiracy. And you see that over and over again. I mean, this research has been done since the late 1980s, yes. when one guy was fired by Drexel Burnham for trying to squeeze the orange juice market and hung out to dry. And he went to the CFTC and said, be lenient with me and I'll show you how Drexel Burnham is squeezing the silver market. The CFTC investigated Drexel and found 2 off-market trades and fined them a few $100,000 for making off-market trades that they then crossed, which is what you did before you had EFPs.
Final question on the squeeze.
We've seen research ever since then that has proven that these things don't exist. But when you show it to a true believer, they say, I'm a true believer. And for me to change my beliefs based on evidence or fact, that's what a thinker does, not a believer.
I see. Final question on the silver squeeze. The Hunt brothers, some people were drawing parallels between what's happening today and what the Hunt brothers did in the 80s. Can you explain any similarities at all, if there are any?
There are really no similarities. One of the things that is commonly believed about the Hunts, which is actually patently untrue, is that the Hunts tried to squeeze the silver market. The Hunts did not try to squeeze the silver market. I actually knew them at the time and talked with them and as well as with the various people who worked with them. And what the Hunts did was they looked at the silver market in the 70s, actually starting around 1974, I believe. And they said, this is a market that is running on fumes. There's at the time a structural deficit of newly refined silver coming into the market relative to the fabrication demand. Silver was used heavily in photography and jewelry and silverware back in the 70s. They said the silver market's running a structural deficit, and at some point the price is going to rise. We want to buy silver, and we want to ride that wave. Once they had their silver in place, some of the brokers and others that were working with them said, do you mind if we tell other clients about this? And they said, absolutely not. In fact, we're going to do that too. And they flew off to talk to their friends in Saudi Arabia, Paris, Rio de Janeiro, and say, look, we've taken a large position in silver because we think the silver price is going to rise. At which point, all of those people came in. So the Hunts didn't try to corner the market. The Hunts saw a wave that would push silver prices higher, and they worked to help emphasize and accentuate that wave. And they weren't trying to squeeze the market. They just thought that the price of silver would rise, and if they could help it rise, it would be good for them too. And that was what they were doing, which has like nothing to do with these guys sitting in their basement playing with Wall Street bets.
Yeah. Okay. Was there? The Wall Street bets community has denied any involvement. So this is where I'm confused, because they initially, we saw posts on Reddit, but then the community itself has denied involvement on shorting silver squeeze, or initiating the silver squeeze rather. So do you have any facts as to who actually was involved, which groups of people and which groups of investors were likely behind this, what we saw in early February?
First off, this stuff doesn't matter to me. I look at the real silver market.
Okay.
Second thing is I'm not an investigator of it. Third thing is if I want facts, yeah, there's this body of evidence that they posted online saying, hey, let's squeeze the silver market. So that's like, Donald Trump saying, Michael Cohen, I hardly know the guy. It's like just total denial of something, It's like, wow, the smartest thing we ever did was videotaping us trashing the Capitol and then post it online. Duh. So they can argue all they want. I don't care, because they're really inconsequential to what's really important in the silver market. And there's some major changes going on in the silver market that are just being overlooked by the silver market. And, frankly, we're sitting there saying, why aren't people in the silver market aware of this and talking about it? Because it's pretty important, structural changes going on there. And people are looking at this, it's a giant distraction.
Okay. Jeff, interesting talk. Thank you so much for giving us your information. Good luck with the webinar on silver on Thursday. Look forward to that. Thank you very much.
Thank you.
And thank you for watching Kitco News. Don't forget to subscribe if you're watching this on YouTube.